Hey guys, welcome back to our first demo video for the class. I bought some new software here and trying to give it a test run here to see how it works functionally and how you guys perceive it on your end. Hopefully it works well, and then maybe I can actually incorporate this going forward. So in this video, we're going to look at exercise 12-2 in your textbooks. Um, and this exercise wants us to do a drop or retain decision. So we are a cycling company and we manufacture three types of bicycles. We have a dirt bike, a mountain bike, and a racing bike. And they give us data for sales, variable cost, the contribution margin, and the fixed expenses. So the first thing, or the first requirement rather, asks what is the financial advantage or disadvantage per quarter of discontinuing the racing bikes. So I'm on page 591. And what we need to do is we need to look at the racing bike and we need to determine what are our relevant costs and benefits, what are our irrelevant costs and benefits. And once we identify those, we say, okay, we know in differential analysis, we only worry about the relevant decisions, or we only worry about the relevant costs or the relevant benefits, right? Those are the only things that we use in making our decision. So, if you remember in class, we talked about make or buy decision, or excuse me, dropping and retaining decisions. And we said that the first place we start off with after we identify what's relevant, what's irrelevant, we say, okay, we start with the contribution margin. So the first thing that we're going to do is we're going to type in what's our loss of contribution margin. And I'm going to abbreviate that and say CM. Well, if we look in our book, we see that the contribution margin is $27,000. So that is exactly what we're losing. We're giving up $27,000 in contribution margin if we decide to drop this product line. Okay? So we identified the relevant benefit, right? Yes, the sales from that are going to go away. The variable manufacturing and selling expenses that we have will also be avoided, right? They're going to go away as well. But we can take a shortcut and just say, you know what? Yeah, we're losing our sales. Yeah, we're avoiding those sales. We are avoiding those variable costs. But at the end of the day, it's the contribution margin that really matters, and that's really what we're losing. Okay, because remember, the contribution margin is what is left after our variable costs have been deducted from sales, and the contribution margin is what is left over to cover those fixed costs. Okay, so we're still going to keep the two other lines, right? The two other bicycle lines. We're just getting rid of the racing bikes. Okay, so the second step then is to list out our avoidable fixed costs. So what fixed costs are avoided? Well, we have a couple of them, right? We have our advertising, which is traceable to the racing bikes division. So we're losing our ad expense, and I'm going to abbreviate that, and that is $6,000. Okay, so we're avoiding a $6,000 expense. The next thing that we are avoiding is going to be the salaries of the product line manager, which is $10,000. So I'm just going to say product product manager salary. Okay, and that's $10,000. So we're avoiding these two fixed expenses. Now, if you notice in the problem, they say depreciation on special equipment. Well, remember, depreciation is a sunk cost. Sunk costs are irrelevant. They never are used in a differential analysis decision. It's a sunk cost. We already paid for that piece of equipment. We're not even going to consider it. Okay. Then the next one that we didn't identify as being avoidable was the allocated common fixed expenses. Well, that makes sense, and here's why. These are fixed expenses that are allocated to each of the product lines. If we get rid of the racing bikes, guess what? The total fixed cost is still there. It's just going to have a new allocation to dirt bikes and mountain bikes. Okay, so the allocated common fixed cost, if you can think back to segment reporting, that's not we can't avoid that by getting rid of this this segment. Okay, so I'm going to go ahead and look, and I'm going to add up all of my avoidable expenses. And by dropping this product line, we're actually avoiding $16,000 of costs. So now what we're going to do is we're going to compare the sales, the benefit of the contribution margin that we are losing, as well as the avoidable costs that we're sort of gaining. And if we add these up, we see that there's actually a negative $11,000. So that means there is actually a financial disadvantage to getting rid of the racing bikes. Okay, so again, this is how we do our drop and our decisions to either drop or retain a segment. We need to first identify all the relevant and irrelevant costs and benefits, and then we compare on the margin, so to speak. Right, we're looking at what's different. Well, I'm losing I'm losing contribution margin, but I'm avoiding some costs. In this case, we have by dropping it, we have a financial disadvantage of $11,000. So that's going to hurt us in the long run. So we might as well just keep this product line in place, because at the end of the day, our income is going to drop by $11,000 if we get rid of this product line. And it all focuses in on that contribution margin. Okay. When we come back for our next video, we'll go over an example of a make or buy decision. So thanks for tuning in.